Section 1.2 Understanding Dividend Payout Ratio. 1.2 Calculation of Dividend Payout Ratio. The dividend payout ratio is calculated by dividing the dividends paid by a company by its net income. The formula for calculating the dividend payout ratio is as follows: dividend payout ratio equals dividends paid / net income. The dividend payout ratio is expressed as a percentage or a decimal. The dividends paid refer to the total amount of cash or stock dividends distributed to shareholders during a specific period, typically a year. This information can be found in the company's financial statements or dividend reports. The net income represents the company's total earnings after deducting all expenses, taxes, and interest payments. It is also known as the net profit or net earnings and is usually reported in the company's income statement. By dividing the dividends paid by the net income, the dividend payout ratio measures the proportion of a company's earnings that is distributed as dividends to shareholders. For example, if a company pays $1 million in dividends and has a net income of $5 million, the dividend payout ratio would be 20%. Dividend payout ratio equals $1 million / $5 million equals 0.20 or 20%. A high dividend payout ratio indicates that a larger percentage of earnings is being paid out as dividends, while a low payout ratio suggests that a smaller proportion of earnings is allocated to dividend payments. It's important to note that the dividend payout ratio alone may not provide a complete picture of a company's dividend sustainability or financial health. Other factors such as the company's cash flow, debt levels, growth prospects, and industry norms should be considered when evaluating the dividend payout ratio in the context of an investment decision. Analyzing the components of the dividend payout ratio formula, dividends paid and net income or earnings, provides further insight into the financial performance and dividend policy of a company. Dividends paid refer to the total amount of cash or stock dividends distributed to shareholders during a specific period. Dividends are a way for companies to share their profits with shareholders. Dividends can be paid in the form of cash, where shareholders receive a certain amount per share owned, or in the form of additional shares of stock, known as stock dividends. The dividends paid component reflects the actual cash or stock outflow from the company to shareholders as a reward for their ownership. It represents the portion of earnings that the company has decided to distribute rather than retain for other purposes, such as reinvestment in the business or debt repayment. Net income or earnings. Net income, also known as net profit or earnings, represents the company's total earnings after deducting all expenses, taxes, and interest payments from its total revenue. Net income is a key measure of a company's profitability and financial performance. Net income reflects the company's ability to generate revenue and manage its expenses efficiently. It takes into account factors such as sales, cost of goods sold, operating expenses, interest expenses, taxes, and non-operating gains or losses. A higher net income indicates greater profitability, while a lower net income suggests lower profitability. The net income component of the dividend payout ratio formula represents the earnings available to the company after all expenses and taxes have been accounted for. It reflects the portion of earnings that could potentially be distributed to shareholders as dividends. By comparing dividends paid to net income, the dividend payout ratio measures the proportion of earnings that the company decides to distribute as dividends, providing insights into the company's dividend policy, financial health, and commitment to returning value to shareholders. It's important to note that both dividends paid and net income are accounting figures reported in the company's financial statements. These figures are subject to accounting standards, adjustments, and management decisions, so it's essential to analyze them in conjunction with other financial metrics and consider the specific context of the company and industry when evaluating dividend sustainability and financial performance.